So in this video, I want to talk about mastering markets and limit orders. Mastering market and limit orders, a strategy for better control. So using a combination of market and limit orders can provide investors with greater control over their trades. But by leveraging the strength of both other types, investors can ensure more strategic entries and risk management while taking advantage of market conditions. So these are the key concepts we are going to consider in this video. So we want to talk about market orders. These are orders to buy or sell stocks immediately at the best available price, in the market. There's no price indicated. Just key in your market order and it will be executed at the best available price, price points. So market orders, provide certainty of execution, but do not guarantee the price at which the trade will be executed. You have no idea of the price at which your order will be executed, but it will be done, speedily. Then let's consider limit order this time around. So for limit orders, these are orders that are placed, at a specific price. They are buy or sell orders that comes with a specific price, attached to them. So limit orders provide control over the price, but do not guarantee execution of the price. There's no guarantee that you can get it at that price, but it's good to specify it. And of course, there will be no execution of your trades if the price could not be met. So you may end up not getting, not buying or selling, the security you want to buy or sell. So how to use market and limit orders together? How do you use market orders and limit orders together? So entering, a trade with a limit order and exiting with a market order. You want to enter a trade with a limit order and exiting with a market order. So limit order for entry. You use a limit order for entering a trade. If you're looking to buy a stock at a price lower than the current market price, use a limit order. For example, if stock A is trading at let's say $100, but you want to enter at $95, so you place a limit order at $95. So this ensures you only buy the stock at a price you are comfortable with rather than overpaying for the stock. So you're comfortable with $95, fine. You could get it at that amount. So market order for exit. You just use a limit order to purchase the stock. You don't want to overpay. You can use market order to exit the stock. So once you've purchased the stock, you can set a market order, for exit when the stock reaches a desired price. So if you want to sell quickly at the best available price, when it hits your target, a market order will ensure that your sell order will be executed you bought the stock. You just watch the market. Once it appreciates, you issue a market order and it will be sold at the best available price. So using limit orders to protect or protect your profits. That is, it is called a take profit strategy. Take profit strategy. You could use a limit order to protect your profits. So in that case, place a limit order to sell when the stock price reaches a desired target. For example, if you buy a stock at maybe $50 and believe that it will reach $60. So you can set a limit order at $60 to sell once the stock hits that price. This allows you to lock in profit automatically without needing to monitor the stock market constantly. You just key in your order and the price at which you want to be executed, and the system will carry it out for you. This strategy can be used for both buy and sell orders, providing a clear point of execution. So using market orders for quick exits and limit orders for planned entries. Using market orders for quick exits and limit orders for planned entries. So in this case, you look at market orders for fast execution. Market orders for fast execution. So if the market is volatile and you need to exit in a position quickly, you simply put in a market order so you can exit the position quickly. So let's also consider limit orders for controlled entries. Limit orders for controlled entries. You want to buy at a controlled price. You want to buy at a specific price, or you want to maybe you want to buy your stock at maybe the stock is selling for $120 and you want to buy at maybe $110. You simply put in a limit order for $110, and then once the price gets to gets to 110, you could buy at that price. So in that case, you've been able to use a limit order to control the price at which you enter the stock. So using stop loss, with limit order. Using stop loss with a limit order. So you can combine stop loss with a limit order to manage risk and potential profit simultaneously. That could be done. It could be done. So you just set your stop loss order. That is, you don't want to sell below that particular order. All right. That is how it is done. So use your stop loss order. Put in, maybe your stop loss is maybe $90. You don't want to sell below $90. Once the stock gets to $90, the system will automatically sell off the stocks. So you can also use a limit order to control your upward potentials. Your upward movements. You say, well, you may put in 120 limit order at the top. That is once the stock reaches 120, it will be sold automatically. That's your limit order, to control your exit at the top, and your stop orders to control your exit at your exit below at the bottom. That is, your stock will not fall below $90. It will still be so. Limit orders, stop loss orders at $90 and limit orders at 120. So if you invariably put a cap and a bottom at where you want to sell. So it's very interesting actually when you know how to employ these orders. Very interesting. So you have to learn them, understand them, and know how to utilize them in the markets. And that will go a long way in enhancing your profitability, as well as reducing your losses in the market as an investor.